Adobe stock has been a Wall Street favorite for several years. In just the last few years, it's rallied several 100%. It's a Wall Street darling, and in all honesty, it's the dream that most SaaS companies aspire to be, tapping into huge markets, rapid growth, rapidly expanding profit margins, lots of free cash flow. That is what a lot of these these SaaS companies aspire to achieve. Here it is, Adobe achieves it. So the question is, does this juggernaut stock, juggernaut software stock, is it an attractive investment from here, especially when investors have seen it drop like a rock in just the last few weeks? It's down about 20%. Down 10% plus today alone. We're going to talk about that and reasons why. Quick overview of Adobe stock if you've never heard about it. And if this is your first time tuning in, my name is Daniel, and you're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. And so as we dig in, in full disclosure, this is not financial advice, and I did not own Adobe stock. ADBE is the ticker at the time of this video publication. And so Adobe is a software juggernaut that is key to empowering this massive global trend of digital transformation. You have the Creative Cloud suite, and that's critical for many artists, designers, developers, marketers, communicators, along with all the underlying industries that they reach. This is about creative solutions. This includes key brands like Photoshop, Illustrator, InDesign, and others. Then you have the Document Cloud Suite, which is about editing and managing PDFs, along with key features like e-signature. In all honesty, this segment reminds me strongly of DocuSign, which is where they also compete head-to-head. The Experience Cloud is one of the leaders in the enterprise marketing automation space. Think lead generation, analytics, and engagement. The way to understand the magnitude of these three core segments is that the Creative Cloud is about 60% of their business. Experience Cloud, the one on the far right, is less than half of the Creative Cloud, and Document Cloud is around half of Experience. So really, Creative Cloud is the behemoth, and that's the one that should get a lot of attention, whereas these others are, they aren't the majority. This really is the majority. That's the big one that's driving it. And look, this there's more to the story than just these three components, but this covers a lot of it. So Adobe is a monster of a company, historically putting up strong growth, around $16 billion in revenue in their most recent fiscal year, growing 22% in fiscal 21, expanding margins currently around 40%, give or take, and significant free cash flow, around $7 billion in free cash flow. And they did all this while beating internal and external expectations. You can see, their original targets versus actual results delivering strongly ahead of each of those. And so it's not surprising and partially well earned that their valuation multiple has more than doubled in the last 5 years. I'm not saying it's unjustified. For a lot of companies, it is unjustified. It's just been a rising, valuation type of environment. They have put up exceptional results. For example, their margins have expanded quite nicely as they've shifted more business to a subscription focus. That's super high margin. That is a beautiful business model shift. The challenge is that the larger you get, the harder it is to sustain that growth. And this can leave investors in an awkward place because the higher the valuation, the more I'd argue you should expect out of a company, and high expectations need sustained high growth in order to keep that high valuation. And the main reason Adobe has been dropping like a rock is partly also the environment changing. I did a whole separate video about this called, Save Yourself, on how the Federal Reserve changing the liquidity profile is affecting all companies. So check that video out if you're interested. But the reason why it dropped 10% plus today is management's outlook for fiscal 22 is only low teens top line growth. The reality is you simply can't put out guidance like that if your stock is valued around 50 times earnings and not expect a harsh response from Wall Street. You are going to get some pressure from Wall Street if you have a very lofty earnings multiple and low teens growth. That just doesn't jive. That's the challenge that I get. Like, the higher your valuation, the higher your sustained growth rate needs to be. Otherwise, there's going to be a reset. So that does raise the question of, well, could it reset lower from here? We'll talk more about their valuation in a second. Management should get some credit here, benefit of the doubt, as they did significantly beat, their fiscal 21 original targets. And the main reason for the lackluster outlook is because their fiscal 21 had an extra week, and because the US dollar has recently been rallying against foreign currencies. So that does make it harder for them to report in US dollars strong growth. So that said, even as adjusted high teens growth rate, that's adjusting for this extra week and, the US dollar adjustments, it still might not be enough for the current valuation of around, 50 times earnings. So, okay, so what about the valuation from Adobe from here? First, a quick plug where if you're interested in following along with my personal financial journey, go to unrivaledinvesting.com, where each month I call out potential multi-baggers, as well as my personal portfolio. We also have an exclusive community dedicated to learning and trying to find exceptional companies on Discord. So if you're interested, unrivaledinvesting.com, click join the journey. And if you enjoy videos like this, learning about exceptional companies like Adobe, please make a point of hitting subscribe and hit that thumbs up button. So Adobe strikes me as an exceptional company, providing critical software tools that enable a global digital transformation. This is a huge tidal wave that's been going on for years, and I expect it will continue in the years ahead. This impacts graphic designers, online advertising, contract management. Their scale and size is the dream of what most SaaS companies aspire for. Now, Adobe is nicely growing cash cow, 35% plus operating margins, 90% gross margins, somewhere between teens and 20% growth. That is really nice. There's potential for even more margin expansion going forward, maybe from 35 to, mid 40% margin expansion. We'll talk about how that could get baked into the valuation in a second. So one question that will need to be raised, arguably in subsequent videos if there's enough demand here, is the concern that competitors, see these really fat, juicy margins and they try to encroach on their turf. They're stepping on their sneakers. And for example, Canva recently raised around $200 million, has a $40 billion valuation. So, quickly getting up to Adobe size, not there yet, but quickly growing in terms of private market valuations, is growing at hyper speed with tens of millions of users and is trying to eat Adobe's Creative Suite lunch. So this is concerning, definitely something I'd want to track over time, especially given that their growth rates suggest that they are getting a lot of attention. So Adobe continues to perform well, though. Look, their growth rates of even projecting, teens growth is still attractive. That said, you do need to ask, will new competitors, impact this along with a lofty valuation? The stock price worked out really well in the years prior, but what about for shareholders going forward? Will this stock keep dropping like a rock? That's a tougher question to answer. If I want to take a stab at it, I'm penciling out mid-teens growth and significant margin expansion from here. I think I'm giving them a lot of credit, saying, hey, maybe this can go from 35 to 45% in the high side and an end multiple of, let's say, 25 to 35 times 5 years out. The potential return is around negative 30 to positive 50 over the next 5 years. That might be lowballing it based on the cash flow that they generate, around $7 billion. So they can use that to sort of juice it with mergers and acquisitions and share buybacks. They've used it for some share buybacks, which in all honesty strikes me as a low return on investment and makes me think management doesn't know what to do with their own capital, given that if you're buying back stock at 50 times earnings, you're talking about effectively a 2% earnings yield plus the underlying growth. It just doesn't, scream compelling. But that said, maybe the return profile is a little better than that. Maybe they even leverage their balance sheet to do some plus size acquisitions. So there is that possibility. So while Adobe might seem like a safe stock, given this strong growth, significant free cash flow, a lot of critical products that, businesses use, it's a question of whether or not this return profile is actually compelling. And in my opinion, not really. That said, maybe I'm wrong. If you have a strong opinion on Adobe, I'd love to hear it. As always, stock prices can go way above or way below a hypothetical framework. It all depends on the execution and sentiment. I'd argue if they are, grow closer to that 10 to 13% growth rate over the next 5 years, then the stock price would in all likelihood reset at a lower valuation and shareholders should expect a lousy return over 5 years. If it's closer to 15 to 20% growth and they're able to expand their margins to, let's say, closer to 45%, you could get a reasonable return, maybe a low teens, annualized return over the years ahead. The reality is I look at this, I'm looking at Adobe and I'm thinking, personally, I want to find more type of asymmetric types of bets. I'm looking for the types of things where if it's an unprofitable company, I want something where it's like crazy asymmetry, like 600, 700% upside. And if it's, if it's a profitable company, a very stable company, for example, I called out one like this for my Unrivaled Investing Journey subscribers, a company that trades well below book value, has crushed the indices for several decades. And it's like, if management just delivers on some, I'd argue, conservative performance in the years ahead, let's say 5 to 10%, compounding plus a valuation reset, you could have, 200% upside from here. And so that's the type of thing that I'm looking at. Whereas here, it just doesn't strike me as super compelling. It strikes me as this is broad market risk, and looking at the changing market dynamics, which once again, I recommend you check out that video, Save Yourself video, where it's talking about tighter liquidity impacting all stocks. This just doesn't strike me as just super compelling. If you have a strong opinion though, please leave a comment below. And if this video has been helpful for you, please make a point of hitting that subscribe button and hit that thumbs up. Thanks so much for tuning in.